Good morning, everybody. It is Wednesday, the 14th of January. This is Morning Blast with myself, Ryan, and of course, Michael. For those of you that don't know or haven't been listening, where the fuck have you been? And on that note, trigger warning do apply to this show. If you, most of you, as we know by now, do listen to this back on the recording rather than tuning in live. Although we do have a special place in our hearts for those that bother tuning in live via Podbean. But yeah, just for those that are not aware, there are no editing magicians behind this. It's just raw, uncut, hence why there's lots of profanities. Hopefully we give you an update of what's been going on in markets and look forward to what's to come, add a bit of value, have a bit of a chinwag, normally have a bit of a rant at something. More than likely Rachel Reeves pops up. But yeah, nothing we discuss is trading or investment advice, etc., etc., etc. Michael, how are you on this fine Wednesday?
Hello, very good morning to you, Ryan. Good morning, everyone. I'm not too bad at all. Rachel Reeves is going to pop up in the recording this morning because I do have some fiscal news in the UK. But perhaps more importantly, how the fuck is it only Wednesday morning?
Well, you say that, but I can't get my mind around it's already the 14th of January because I don't know.
Do you know what? I was just having this conversation with one of our main sales guys. It's the 14th of January and silver is already done 27% on the year.
It's mad, isn't it? And I'm glad you mentioned that because we are going to be talking about silver and what's been going on.
You see,
I see what you did there. But yeah, obviously a great place to trade silver is Pepperstone.
Yes, we're not really meant to mention, but yeah, go for it.
No, I'm allowed.
I didn't mention it, so
I'm allowed to mention Pepperstone being an excellent place to execute your orders.
And that has absolutely nothing to do and no correlation with the number of beers I may or may not buy you at some point.
And we have to stress that Pepperstone have no relation to this show whatsoever, apart from Michael working at Pepperstone, because the reason and don't get me wrong, listeners, I have tried to get some money out of Pepperstone to sponsor the show, but the words compliance and HR were mentioned a few times, and basically told to look, Ryan, you've got two options. You can either mind your language and stop being a bit of a cunt, or and then we can back you. And I was like, we'll make our own way in life.
Indeed.
Well,
I was going to say the good news is that I believe Clive is back, isn't he? So I don't have to talk about markets.
Oh shit! No, you better because I forgot to check.
Oh, you moron!
No, I haven't got.
Well, Ryan goes and checks.
No, he hasn't sent me anything.
Oh, Clive, you've let us down. You promised us you'd sent us an email.
My fault. I should have actually checked, but no email.
Dear. Right, we'll throw Clive under a bus. We'll
start tomorrow.
Maybe a camel because he's in Abu Dhabi, whatever. I will do the market rundown then, in that case.
Yeah,
but thankfully, there's not much to talk about because what we really saw on Tuesday was basically just an unwinding of what we saw on Monday, where everyone started the week kind of panicking and fretting and very jittery, and rightly so, about these threats to erode the Fed's monetary policy independence. Treasury's lower, dollar lower, stocks kind of gyrating around all over the place. And then yesterday we saw Treasuries rebound and pair pretty much all of those declines. The dollar erased all of those losses that we saw on Monday with the dollar index back north of the 99 figure, and stocks closed just marginally below the flat line, but the S&P future still north of 7,000. In terms of other market moves, obviously the big one, as we've already alluded to and we'll talk about more momentarily, is this continued rally that we see in the metal space. Not just precious metals, obviously gold at fresh record highs north of $4,600 an ounce, silver record highs north of $90 an ounce, but also in terms of base metals as well. Copper's printing new record highs, tin traded to a record high overnight as well. It's almost getting to the point where it's going to be easier to say which metals are not printing all-time highs than those which are trading at those levels, but absolutely no sign of that rally slowing down any time soon. In terms of fundamental drivers yesterday, I'll just run through a few bits and bobs before we move on to our discussion momentarily. Of course, all eyes really on the latest US inflation figures yesterday. Headline CPI rising by 0.3% on the month in December, bang in line with consensus, and also rising by 2.7% on the year, which was also bang in line with consensus. The core metrics, though, were a little bit softer than expected at 0.2% on the month and at 2.6% on the year. And importantly, we saw a further cooling in core goods inflation, which came down to 1.4% on the year, down from the prior 1.5%, which implies that the bulk of that tariff-induced inflation could well be behind us. I would caveat that data, though. by saying that the CPI figures are skewed lower than they otherwise would be and will remain so until kind of March, April next year. There are numerous statistical reasons for this, but essentially it comes back to the BLS were unable to collect data in October due to the government shutdown. They had to make a whole host of assumptions about prices, and the effect of those assumptions is to skew headline and core CPI to the downside. So the policy implications of the data are probably relatively limited.
Yeah.
Other than that, Trump was being Trump again, kind of talking on absolutely every subject imaginable in remarks to the Economic Club of Detroit. He was reiterating his calls for the Fed to lower rates, saying that Powell is not doing a very good job and that Jay Powell is, and I quote here, either incompetent or crooked. His words, not mine. Let me stress that one. Trump was also saying that he wants the next Fed chair, and of course, Kevin Hassett and Kevin Warsh are the front runners for that job, to, and again, I quote, put rates down on good news. When the market goes up, the Fed should lower rates. I really do pity the White House intern who has to explain to Trump that the Erdogan school of monetary policy is not the one that we should be following here.
But this is the thing, though, right? He has filled, his interns are made up of blondes with big tits from Mar-a-Lago. So, yeah, look, I'll be honest. Yeah, I'm not
sorry,
knocking it.
I wasn't expecting that, and I was having a sip of the water.
I'm not knocking it. Yeah, it's what I would do, but then I'm that's the reason I wouldn't ever be in power. I can better power myself.
Well, yeah, quite. Even though that's not necessarily the most politically correct description of what's going on, I think it's probably quite an accurate one. So, yeah, expecting any pushback on that monetary policy theory it's not going to happen, is it? Let's be honest with you. Yes. Trump was also talking about geopolitics, saying that he has cancelled all meetings with Iranian officials until the killing of protesters in Iran stops. For those unaware, of course, there are really significant protests going on in Iran at the moment. I don't want to be one of those people who goes, oh, it's not on the news, but actually it doesn't seem to be getting as much coverage as you might expect.
Sorry, counterpoint. Yes, it is. Yeah, it is terrible what's going on in there, and the regime does need to be stopped. So quickly, two things on this. One, I hope there's someone like Trump that's all fart, no poo at the moment by saying we'll do something if they kill people, we'll do something if they kill people. Well, they are killing people, mate. So put up or shut up.
Yeah, exactly.
If you can. But to a little bit of pushback, and we do love a good pushback story on this show, a little bit of pushback on this. It's very easy for many people to say, oh, it's not on the news, I'm not seeing it on the news. It is on the news, but a lot of people, what they're listening, because there's some kind of bias in place where it is being found that, I'm not seeing it a lot because it's not everywhere. For us, we can be a little bit, due to the nature of what we do, we are focused on geopolitical events and whatnot. And so we do see a lot more of it on Twitter or where, on Bloomberg or wherever we're looking, because we're actively looking for updates. I think if you take yourself...
Or PRQ Suite.
Or PRQ Suite, indeed. And there's major upgrades going on over here, so do keep an eye on that.
Sorry, I'll do your advertising.
Sorry, I'm really bad. I was saying to Zach earlier on how poor self-marketing I am. So I would have a little bit of pushback on that because it is out there. But one thing to be aware of, it's actually very difficult to report on it because the regime has basically severed most ties for information getting out. So let's just be mindful of that. But also I have seen reports, and I can't believe I'm saying this, so please, this isn't a cry for help, but a small defense for the BBC. Because I've spoken to some people, Persians actually, and apparently BBC Persia, which is obviously like a sub-unit of BBC. You've got BBC World, etc., etc. Apparently, their coverage has been phenomenal, and they
are meant to be quite good. I've heard that as well, actually.
And I guess, and for the Persians, and in actual fact, two of them Iranian families. Well, they are Iranian families, and they would be desperate for everything to be sorted, and the mullahs to muller off. But no, they had a lot of praise.
Or get mullered.
Put Mueller in the corner.
Right, let's end that right there.
Right, anyway, do you see where I was going? But anyway, moving on.
Yes, no, that is a fair point. And I think, you are absolutely right. We do kind of get swept up in a bit of a market bubble every now and again. Just two other things I wanted to mention very briefly. First of all, as promised, Rachel Reeves, we haven't spoken about her much this year. Bloomberg reporting yesterday that they have done some maths. Alex Wickham, their main politics guy, who is very, very good and is worth your time in terms of reading his pieces. They have done some maths as to how the government's policy changes since the November budget have impacted our fiscal headroom here in the UK. You'll recall, of course, that the Chancellor built that headroom up to just shy of £22 billion at the November budget. And that was more than double the £9.9 billion that she previously left ourselves. However, of course, since November, we've had, it's becoming comical, frankly, the amount of policy U-turns that there have been, chiefly in terms of business rates. We also have significant spending pressures in terms of defence, which were not accounted for by the OBR. And there has also been an increasing clampdown on immigration and, of course, changes in net migration and, of course, significant emigration, I should add to that, are going to impact the budget as well. The nub of all of this means that Bloomberg estimate that as much as 2/3 of the Chancellor's fiscal headroom could now have been wiped out by those policy changes. Of course, the OBR give their next assessment on the state of the economy on the 3rd of March. That is not meant to be accompanied by any policy announcements or any policy changes. However, it does seem increasingly likely that the doom loop is just going to continue. Yeah. And of course, this is all, the important context here is that the £22 billion of headroom is predicated on significant, what we would call backloaded tax hikes. Basically, the Chancellor has promised, I'm going to hike taxes a lot in the year of the next general election, which was already stretching the bounds of credibility. And I think this is just the first major bit of poor fiscal news this year. There's going to be a hell of a lot more of it, let's be completely honest. And on that note, we get the latest public borrowing data next Thursday morning, which is not going to make a particularly pretty reading. And lastly, just from me this morning, just wanted to cover off JP Morgan's earnings. Of course, they kicked off Q4 earnings season yesterday. And I've got to be honest, it was not exactly the most auspicious start to Q4 earnings season. And I did end up with a little bit of egg on my face because about 10 minutes before the report, I made the infamous claim on the desk of it's JP Morgan, they're guaranteed to beat expectations. Well, they didn't. They missed on both top and bottom line. Although when you dig into the numbers, the underlying metrics were actually relatively solid, at least in terms of FIC and equities trading. The main reason why JP Morgan disappointed was because they took a significant credit provision in the fourth quarter to the tune of $4.5 billion. And about half of that came as a result of JP Morgan taking on the Apple credit card from Goldman Sachs. I think ordinarily, markets might have been able to look past that. But of course, in an environment where you've got Trump running around saying we want to cap credit card interest rates at 10%, and JP Morgan are then saying, oh, well, we need to take even more of a provision on our credit card business. I think that left some market participants kind of scratching their head and saying, actually, are we going to see the consumer side of the operation, the credit card side of the operation, become an increasing drag on JP Morgan's profitability and revenues as we move through the next year or so? Yeah. So not the best of starts to Q4 earnings season. We also had Delta Airlines report yesterday. They actually delivered decent numbers, but they trimmed their year ahead guidance, which again, not necessarily great. And of course, before the market opened today, we hear from the likes of Wells Fargo, Citi and Bank of America. And it's safe to say that we'll be looking for considerably more robust figures from those three than we got from Diamond and Co. yesterday.
I mean, I think as well as every one of these, regardless of if they miss or beat or miss, everyone's going to be mentioning this rate cap that Trump is trying to get through, and they're all going to be very pessimistic about that. So the guidance could be a bit vague or disappointing, should we say? Just one to keep an eye on there.
Yes, I think
don't know is Trump's pushing through or trying to make it, trying to push through that there's a cap of 10% on charges and stuff like that, which is obviously going to hamper some people. Cool.
Yeah. Any more? Well, it's going to hamper the banks and the credit card providers in terms of their revenues. But I think, no one's going to cry for them, let's be honest. I think the bigger issue with this, and this is going back to what we were talking about the Fed with these unintended consequences, the bigger problem is that actually a lot of these companies will just say, well, unless you've got a really impeccable credit score, we're just not going to extend credit to you because we can't underwrite that risk. We can't charge a high enough interest rate for that to be worth our while. So again, I understand why Trump's doing it, and it's a headline-grabbing measure of, we've got your back. We're fighting affordability. These big banks who hate you, we're going to go into battle with them on your side. But just think about the second-order
Well,
effects, and actually, this isn't going to be quite the boon you think.
Well, quite. And funny enough, this is now turning into today's topic of the day, but no, there's no harm in that. But quite, and I actually put out a little post a couple of days ago about everyone wants fairness until it hits them. Everyone's saying, "Oh, I don't want to be paying, these rates are extortionate. Why can't I take loans out? Why can't I borrow at cheaper rates?" It's because you're a risky asset to the person that's lending you the money. Now, if you want things to be fairer, if you want things to be, if you want rates that you're repaying back debt to be lower, you need to be less risky. Now, Trump's coming in and saying, right, okay, we're going to put a cap of 10% on these credit lines and loans and whatnot. So as you said, the first thing the bank would do is, well, if someone is a risky person to lend to, we need to charge that risk premium. We need to know we've got that. It's making it worth our while. If we're not allowed to do that, we simply won't lend to people. It's not like they're going to say, oh, well, that person from, a day before this law comes in to a day after, their risk profile has not changed. But what has changed? Go on, sorry.
I was going to say it would change, and this would be, and I'm not. Well, Mr. Trump, this is a free idea.
Sorry, what I mean is the person who's the person who wants to receive the money, they're still as risky as they were from Monday to Tuesday.
No, that's what I was going to say. So the only way to make this an effective policy is if you come out and say, okay, fine, we want a 10% cap on interest, but we will underwrite it. That's the only way you can. If you're the federal government, you say we'll underwrite it. That's the only way you can make that an effective policy. And we've seen a similar sort of thing here in the UK, where I think in terms of mortgages, the Treasury was saying, we want higher LTV mortgages and we will step in and underwrite a portion of it, which the banks then went, okay, fine, because we don't have to carry that risk on our book now. Whereas if you have to carry the risk and you can't charge for that risk, then the banks, and saying they're not going to extend any credit is obviously an extreme example. They could cut credit limits and all the rest of it and do all that sort of stuff. But the overall impact of this will be a monetary tightening because there will be less credit available in the financial system. So it just feels like it hasn't been thought through. Well, anything that the two main supporters of it are Trump and Bernie Sanders, I'm going to take with a bit of skepticism.
Well, this is
rightly so in this case.
Bernie doesn't think of any second order effects, and Trump tweets policy from the shitter. So there you go. When they're
literally, isn't it?
When they're agreeing with something, it kind of sums it up. But anyway, just one thing that's enough of that. One thing that we wanted to chat about today, mainly because our friends over at CME, that is an endorsement. Big fan of CME. Love you. Yesterday we had the announcement that they are releasing 100-ounce silver contracts, and the reason they're doing this is, what we're seeing more of the same from these big exchanges is pushing into retail markets. The interesting thing about this is, traditional exchanges like the CME, CBOT, etc., spent decades catering exclusively to institutions and professional traders with direct market access, DMA. If you ever see DMA mentioned regarding trading, it's direct market access. So these are traders like myself. I don't like to mention it, but we used to trade. Well, I used to trade directly on the exchange rather than through a retail broker or anything like that, or a subsidiary. Retail traders were an afterthought, but then along came the pandemic. And obviously, no one had anything to do. There's only so many times you can have a wank during the day, so people started trading.
Oh God!
Then people, it's either wank, have your 10th wank, or have a punt on the Eurostox or the FTSE. There you go. So people started trading.
Safe to say that's not a line I'm going to suggest in our marketing meeting later on today.
Put the sock down, pick up the mouse. There you go. Put the sock down, buy a Tesla contract. There you go. But anyway, so retail was an afterthought, right? And then obviously you got during the pandemic, you have meme stocks and zero day options, etc., etc. And obviously because of that, we had the rise of Robinhood and came out of nowhere in the US. Obviously, you already had the established retail brokers such as Pepperstone, great company, especially in APAC, massive in APAC. And, it was like you had like Wall Street bets and all this opening up. And, okay, these retail guys, they're not big money in terms of, commissions derived from one trader, but there's fucking millions of them. So, but now the world's largest derivatives exchanges are racing to capture this retail flow. And which is why we already had e-mini contracts. So you've got like the maxi contracts for the S&P. You've got the mini contract, which is like $12.50 a quarter of a tick, so trading 0.25s. But now we've got even micro minis, which launched in 2019, just before the COVID move. And we're just seeing a real acceleration of smaller contracts, simpler products, and partnerships between these big exchanges and directly with retail brokers. And the thing is, well, they're cash settled. We're even seeing now CME coming out with things like perpetual futures. So, one of the risks of futures is every month you've got to roll it or else it expires. Okay, so stock market, equities and stuff, they're going to be cash settled. So there's no physical delivery, but you still had the roll to deal with. So I think it's really interesting, and it's something that's not going away. I know from my contacts in the CME. I've known about their retail push, their real hard retail push for some time, and there's far more coming down the pipeline. It's quite exciting to look behind the curtain of what CME are bringing to market over the next 6 to 12 months, and the kind of the schemes that are put together. But I think, to be honest, for me personally, I think it's a real promising thing for the industry, Michael. I don't know about you, because before it, the likes of Pepstone and stuff can now actually trade CME futures. I think CME now have like 130 plus retail broker partnerships. So whereas before, people like Pepstone, people like whoever were having to make their own market, which added an element of risk and an element of mispricing and whatnot. But now it seems to be that CME are joining forces with people, again, like Pepstone, etc., to say, well, hang on, let's offer the best products we can.
Yeah, I think it's a really, really big step forward for the industry. I mean, from the caveat being, CME, make sure your fucking data centers work. But having said that, I think I completely understand from the CME's point of view, they're going, people are trading these products, but why aren't you trading them with the world's biggest exchange? Let's offer you a product that you can trade, or you are more comfortable to trade in smaller size. And from the client's perspective, again, I think it's only a good thing, because you are increasing liquidity, because everyone's trading the same product in the same place. So you've got a much deeper and more liquid market. You're also improving things like price transparency, because you're not having brokers making their own market, making their own prices on the FTSE or the DAX or corn or whatever the hell it might be. You're looking at the futures price, whether it be the front or the second month or whatever the hell you want to trade. So again, from that perspective, that's a benefit to retail traders, or any trader actually, in all honesty. And then of course you've got likely improved pricing on the back of that, because a deeper market, a market that's easier to transact in, you're going to be trading at tighter spreads as a result.
When we are in volatile times, I think you made a good point about it yesterday, or the day before, Michael, about, let's have a boring day for once. When we are in these increased volatility moments, where would you rather your order, where would you rather your orders sitting on, like, the biggest exchange in the world with all the liquidity, or somewhere that's providing their own liquidity via a prime broker liquidity or prime liquidity provider that's basically LMAX, but going through 20 other pipes?
I mean,
it's liquidity providers all the way down, and it all runs off of one book. And if that book, if someone decides to pull those prices, all retail brokers get one, unless they're tied up with CME and etc. All their orders get pulled, or all their liquidity gets pulled, and you get stopped out of a price that's probably 10% below where it actually last traded.
Yeah, exactly. If anyone wants to hear my prime rant, then just come to Jampot at like 3ish one afternoon and buy me a beer. We'll be there till about 10 p.m. because that is a proper bugbear of mine. All of these, you get, I'm probably going to say things I shouldn't say on a podcast now, but things like finance magnates, for example, of the industry summit in London. You walk around this hall and, probably 90% of the people there go, oh, do you want liquidity? Well, no, not from you, to be honest with you, because where the fuck are you getting it from? It's coming from about 15 other people who are all taking a spread out of that before you then try and give it to me.
But more so, it's coming from the people. It's basically coming from the booth next door to them, and it's coming from the booth next door to them. Like you got that that whole thing was like turtles all the way down. It's basically prime broker, prime liquidity providers all the way down, prime, and you only need one of these to go wrong, or one of them to pull their orders, and the whole retail industry falls apart. Which is why, I think it's really good that we are becoming, the industry seems to be growing up. But I say that loosely because I take one look over at some of these less reputable funded trader programs and fucking brackets, prop shops and stuff like that. And it's some of that I think that needs a scythe taken to that and kind of really cut down, because
that needs to go away. Let's put it politely.
Yeah.
But I agree with you. I think it's to coin a phrase that I've literally just made up, the sort of institutionalization of the retail world, and that can only be a good thing. There you go. You can use that in your sales pitches. Yeah, that can only be a good thing. Ultimately, there is a reason why the significant traders, whether it be prop arcades or whatever, have been using CME products for donkey's years.
Yeah,
because they're the best products out there.
Yeah.
And if we can all get to that, then I think that's only going to be a good thing.
I got to say, when you use the institutionalization of retail markets, that made my willy move.
Ooh.
Go on. Ooh. Right. On that note, what's happening today?
Yeah, I think we probably should end that discussion there. That's a horrible mental image. Apologies to our listeners, and I'm very glad we've got the little explicit tag on here. Anyway, as for today, what's going on? All about US data, really. At 1:30 this afternoon, we get the latest retail sales figures. This data referencing November. Headline, excluding autos, and the control group metric, all seen rising by 0.4% on a month-on-month basis in November. At a headline level, that would be compared to the stagnation that we saw in October. Do bear in mind that this data is somewhat stale, but it is the first of the kind of key 2-month festive period in the States, so nonetheless worth watching closely. Also at 1:30, we'll be getting the November US PPI data, November data, not December. PPI seen rising by 2.7% on a year-on-year basis in November. There is no prior for that data because the Bureau of Labor Statistics will be releasing the October PPI figures in conjunction with the November data. So again, as a result of the government shutdown, things are delayed and a little bit messy. And obviously we will be getting that data at the same time later on today. Other than that, of course, the corporate earnings before the market opened that I mentioned earlier on from the likes of Wells Fargo, Citi and Bank of America. It's also quite a busy day of central bank speakers as well. We've already heard from the BOE's Alan Taylor this morning, who was talking about how the bank need to get to neutral as soon as possible and reiterating his view that neutral rate is around the 3% mark. But it's a busy day of Fed speakers too, with Paulson, Myron, Kashkari, Bostic and Williams all due to speak today. Of those, everyone apart from Bostic has a vote on the FOMC this year. And not only will market participants be seeking their remarks on the policy outlook, but of course also any potential comments on the legal situation regarding Chair Powell and those DOJ subpoenas. And of course, in addition to all of that, market participants will continue to pay very close attention to geopolitical developments throughout the day, not least those in the Middle East, because of course Trump was talking about Americans needing to basically get out of Iran yesterday. So we will keep a close eye on what happens there. But for the time being, that's all from me.
Just finally, you mentioned geopolitical events at the end. There's just been some news come through on the PIQ newswire via our good friends at Reuters, which we have the distribution license for if anyone's asking. We don't scrape it like those other mugs. White House envoy Steve Witkoff and Jared Kushner are reportedly plan to visit Moscow to meet with Vladimir Putin. The meeting was contingent on various factors, including unrest in Iran, and its timing is not yet finalised. But keep an eye on that, because no doubt there'll be some headlines surrounding that, and obviously that would be a big story. Probably one of the conditions is Trump Tower in Moscow, no doubt. But there we go.
Well, I was going to, without dragging a podcast on, well, that's just becoming endless now, isn't it? Yes. Russia come up with a list, they send it to Ukraine, they come up with another list, we just go around in this cycle, and we all want to see that resolved and sustainably resolved ASAP in a manner that is going to be an enduring peace agreement. But sadly, I think my expectations for that are as low as they ever have been. I think. Yeah,
unfortunately, I make you right. But Michael, great talking to you as always. I'm gonna leave on a joke.
Oh no!
Man walks up to the counter and he says, "Can I have some fish and chips, please?" Woman behind the counter goes, "Sorry, sir, this is a library." He goes, "Oh shit, sorry, can I have some fish and chips, please?" Bum.
Well, that can't be you because you wouldn't see over the counters.
Wow, goodbye. See you all tomorrow.